Hello, everyone. We're going to just have some fun watching the market through this FOMC meeting. So if you have a question, I see there's a bunch of people over there on the YouTube page. If you have a question, feel free to ask. We do have a bunch of people in the Hangout here. If you guys are in the Hangout and you want to ask a question, feel free. Although I don't really have the Hangout chat box open, so I'm not quite sure how to do that. Anyway, I do see all you guys over there on YouTube. Maybe that's the best place we can do this. What do you got here? I love this new user's name. Forest Real Estate Group, brokered by EXP. Hello, sir. Party. So consensus is, I think, for a 50 basis point increase in Fed fund rates. I have on the screen here, I've got the long U.S. Treasury and the 10-year U.S. Treasury. I don't actually have on the short paper. Maybe what I'll do is I'll throw on the euro dollars underneath the U.S. dollar here. Let's go. Nope, that's not what I wanted. This button. GE1. This might give us a bit of a spot. Oh, there we go. All right, so euro dollars is the corporate interest rate market. It'll be interesting to see how the corporate market interprets the Fed. In fact, maybe we can even put the, well, as is. So, and actually on the site, we've been following along. Where did I put that? I guess I put it away. Anyway, let's pull up. What time is it? 5 minutes till the announcement. Still waiting. The Fed spread. So this is sort of the graphic of the market right now. Euro dollars come off substantially, which has caused the TED spread, now called the Fed spread, to crank up here. We'll see what the Fed funds does. Right now, you can see they're setting 95.665. Have they priced in that increase? Is that what that move is? I don't know. Tough to say. And more importantly, if you are watching short-term interest rate policy and all that, what are these euro dollars going to do here? That's probably the $64,000 question. Here is our current money and interest rate cycle. The average over the past 40 years of interest rate increases is about 3.5%. We're now sitting at about 4.5%, so we're above average. And as you can see, this cycle, the bottom of the rates topped out there sort of like October, November 2020. And we should actually see a peak in the trend in the rates sometime around August, so in about 6 months. If we're really lucky, this is the start of some sort of bottom here. And maybe if we're lucky, we get sort of like a bottom that looks like that, and then a prolonged, protracted decrease in interest rates, which should help our, Bitcoin crypto story, especially once we get beyond this window, because then we start getting into halving events and all that kind of fun stuff. But we got to get through this next 6-month window here first. Fed's been talking recently about the market's been a little happier about inflation. That's this orange line going up. Market's been a bit happier, so Powell's been sort of like, oh, we got wiggle room now. And really, the easy way for you to look at this is, what is this? This teal line is the Fed spread. And if it's above 1.0, then we all got trouble. And you can see, there it is, that dotted line. This is where Powell's like, oh my God, we've lost control of the system. Down here, he's feeling a hell of a lot better. My hunch is he probably is feeling better, but he's probably going to say we have to remain vigilant, because if this starts cranking above 100, then we get trouble again. So, like I said, it's all going to be predicated on what the corporate interest rate market thinks here. So, anyway, that's the backdrop. Actually, we had a really good conversation in the daily brief yesterday, although we should have this interest rate decision come out in about 2 minutes now. And really, our rule is, anybody who's watching on YouTube, the rule is, don't trust what you see in the market for 1 full hour following the actual FOMC announcement. And there were so many people that followed that rule that they actually ended up about 10, 15 years ago going, we might as well have a press conference here, because nobody's doing anything. They're just waiting for that hour to pass. And so then they created this press conference. And interestingly enough, that usually chews up about an hour's time. So you can see here on the West Coast, it's 11 a.m. My hunch is by around noon, 12:30. That's when we'll sort of know what the trend is going forward on all of this. And actually, it's interesting. Some site members were commenting earlier today. There's a lot of fun, these fun little cryptocurrencies. I don't know whether you want to get involved in this Bankman-Fried guy, but there are some fun little cryptocurrencies that are showing signs of strength. Is this thing going to go and W out here? And you can see all the momentum indicators are all pointing out. So, what's that? Yeah, usually my little this thing starts to go a little bit haywire. You get the little wow things. I don't see them yet, so I don't know. Yeah. All right, boom. There we go. United States interest rate projection. So they give out, here we go, 4.5, boom, they nailed it. Yeah, Fed rate decision reported at 4.5%. So there you go. All right, so the damage has been done. Now let's see what the hell happens. And like we said, prices could jump all over the place here, folks. So don't sort of believe what you see right out of the gate. And look at that, eh? Boom. Merry Christmas. All right. If anything, we should have some like Benny Hill music right now, right? Look at the bonds. Holy moly, all over the place. Wow, look at that move. Interesting how US dollar itself not really moving too much here. There goes the euro dollars. Remember we talked about what are the euro dollars going to do here? That's probably the market you want to pay attention to. Yeah, I would imagine. And keep in mind that we're just starting this. In 1 hour from now, you might see that everything looks completely different. But holy geez, here's the stock market down in the lower left-hand corner. I'm not quite sure what the video is that Chris is playing. It looks like some sort of porn or something. My God, look at the size of her breasts. Yeah, well, you can see her up and down like you know what. Look at that corn. The corn's come off like $400 there in just a heartbeat, eh? Look at this stock market just puking out here. Wow. Where's drawers? That's right. So look at that. Everything is just coming off. Interesting enough, the only market that's holding in here are the bonds. The bonds are kind of just look at that. Gee whiz, look at these things just tanking. Woo-wee. Well, that's why I always tell you, don't trust what you see here. This could get pretty crazy. But bonds tick back up, so they're trying desperately to hold in here. Bitcoin coming off, Ethereum coming off. Geez, Ethereum's lost $50 here. Not too bad, I guess. Bitcoin's lost about 500 here. ES is down about 50 points. All right, here. So there's your knee-jerk reaction. These are 3-minute charts. So we should at some point, and really the question is, do we break key support? You can see crude's coming up to a support line. Pretty well structured double top. I'd be sure that's a triple top, isn't it? So I would find it hard to believe that we're going to bust up through the top there, but we will see. Stock market. Remember we had that huge move the other day. Actually, this is Bitcoin, isn't it? Interesting. There was a horizontal support and resistance line there. We should probably look into that. So as far as I can see, it looks like we're just coming back into the overnight support that we had before that huge move up in the stock market. Yeah, so there's that huge move up we had in the stock market the other day. And then they gave most of it back. So they rallied back, and all we're doing now is flirting with the bottom end of the range here. And it seemed to me that there were buyers that were willing to step in at this level here. Now, Julian, one of our site principals, he was saying if these levels are taken out here, it's good night. Probably now, on the stock market itself, if we do actually go and break this, and my hunches are probably heading down that area, down into there. And interesting enough, that still won't break the bottom that was put in there just a few days ago. Anyway, so there's your knee-jerk reaction right out of the gate. Boom. Big down move. And I could see this go a bit, but look how big that line is. I could see this go a ways. Probably also, too, if we break this low, we could do Foggin bombs. So that is there. Oh, all the way down there. That might even be like an alt A, B, C, D. NASDAQ, interesting, because, of course, crypto, you guys all crypto fans. So did NASDAQ go and break that low yet? Oh, yeah, it did. As I said there a moment ago, you can't trust anything that you see here for the next hour, though. So don't draw any conclusions, especially since the old man hasn't even started talking yet. There's the ABCD on NASDAQ. And again, and they do that big technical move. All it does is just takes us back down to the original bottom. So I don't know whether there's even really any major breaks here yet. Anyway, we will see what happens. All right, so we had the knee-jerk reaction. Interesting. Look at that. What pattern is that? Did that just fire on the US dollar index? So that's interesting. Outside upside key reversal on the 3-minute chart. Who's a sharpshooter trader? Actually, be interesting to see whether this big double bottom here actually fires. So that low is 103.50 and a half and 103.50 and a half. Wow. So that'd be interesting. Let's just paper trade. We'll buy on a stop above that breakout. Where is that? 103.56 and a half. So you're going to risk 6.5 points roughly. Let's see if you can get 2-to-1 out of that. And you'd probably want to sell half of the position on that move your stop to scratch, and just see where the wind blows. Interesting how there's a gap right up there. We had seen that gap before the announcement. Oh, we'll keep an eye on that through the frivolity. Bonds had that huge doji bar, but it looks like they're taken back. This will actually become a pretty big sell signal if we break through those lows. So all you bond traders, oh, look at that. 10-year just went through those lows. So that's pretty bearish. Ironically enough, that should actually be bullish for stocks. But maybe just in the short term, people are just waiting for Mr. What's-his-face to start talking. The gold and silver sure are coming off in a heartbeat. And, the risk on, risk off trade goes risk off would be the bonds, the Japanese yen, and the gold, and they're all comfortably heading lower. The risk on trade would be crude, which is trying to hold in here. The stocks, which are over here, and we talked a little bit about the stocks. So they just broke to new lows. It looks like they're heading down. And, of course, good old Bitcoin. So I'm surprised, actually, to see the stocks actually leading, but Bitcoin's holding in there. That's a bit surprising. So we're coming up. Are we going to start to fog and bomb out if we take out these lows? I think the NASDAQ already did take out those lows. Be interesting to see what happens here. Keep an eye on that US dollar index. If that thing does double bottom, we'll probably see a pretty substantial rally. But what's his face hasn't even started talking yet, eh? It says watch live December 14, 2:30 Eastern time. So he doesn't even start talking for another 20 minutes. Probably, my knee-jerk reaction here would be thinking that the market is selling off. And as soon as he starts talking, then the market will start pivoting. Somebody says CPOW. Kapow. Is that a stock? Stock and stocks or blonde and blondes? Well, interesting. Crypto came backed off there, right? So you never got that breakout on SOL, Eddie. I think, Eddie, you are SOL on your SOL. What was that you said? CPWO? A stock? Crypto? Cryptopolis? I think he meant Chairpow. Oh, Chairpow! Notice, and actually it'll be interesting through this press conference. Let's see how many men say Chairpow and how many women say Chairpow.
We should make it a drinking game.
Yeah, well, if a guy referring to him doesn't say Chairpow, you got to drink. If it's a woman and she doesn't say Chairpow, you got to drink. But then that means we probably won't drink at all. Somebody wants me to look at ANX. Actually, FYI, if you're watching on the YouTube public stream, we'll probably do another one of these tonight, which will be specifically crypto. So maybe see if you can tune in for that. ARGUSD there on BitGet. I have no idea what that is. Brian, please check OKT. All right. Anyway, we'll look at this one first. ARGUSD. No, there's nothing to look at there. And then somebody wants OKT. SDT again. Oh, you guys, are you on the casino? Is that where you're trading this? Or are you guys doing this over in DeFi land? I do hear a lot of people talk about this Gate.io, but I've never been there. Anyway, on OKX, I guess that's the casino. Well, yeah, you're right. That's not a bad looking chart. I mean, the cool part about it is you're not walking into a trap, so that's kind of cool. Yeah, it's not a bad idea. I don't know anything about the fundamentals or the structure of the story. I always like to just determine whether it's a bull based on the weekly chart and then the moving averages. So right now, I'd have to say that your asset is. Oh, look at that! It's trying. Oh, look at that! It turned up. You son of a gun. This is the okay. So I guess that makes sense, right? If they're going to try and do kind of like a CZ thing with the BNB, because BNB has done really, really well for them, eh? So if OK Coin is trying to pull like a CZ and Binance, then a lot of people made a lot of money buying the site's token. But yeah, that's not bad. I mean, that's giving a trending signal. So on our site, the way that I would recommend that you approach it now is now you want to draw your reload zones and all your fancy schmancy technical analysis, and you want to start hunting. Looks like, top of value reload zones right up in those moving averages. I don't know whether it makes sense to buy that there. And now that this is bottom upside objectives, you can start doing Foggenbaums. So there to there and up to there. So I wouldn't be surprised actually if this thing rallies up to that level. And usually what we see happen is the market rallies to 2.618, then pulls back, tests 1.0, and that would probably be your buying window down in there, something like that. Interesting how reload zone's all the way down here. So it might be a little bit lower. Like that. Could be something like that. So that's the way I would approach that. So caveat emptor. It's not a bad idea, though. At least you're heading in the right direction. Nice little tag of this trend line from the other side. That would make sense. All right, let's go check in with how things are going over here. Euro dollar still heading lower. So the Fed fund futures didn't move here. That's I guess they had just priced that in. So TED spread's still working its way back up. Our matrix. Let's see how we're doing here now. Wow! Hey, what do you think? Would that have been a good trade on the US dollar? Fuck me. Look at that, eh? Wow. What do you think? See, and it's always the ones you don't take, right? That would have bought you your Lambo right there. Boom. Oh, look at this euro dollar contract just puking out here. Oh boy, that's not a good sign. Euro currency, US dollar had a big jump up, so that's basically that dump in the euro. Is this a bear flag now here? Usually these move in like two phases. You guys probably often hear me go A, B, C, D. So is this the A to B, and now there needs to be a C to D? Maybe. And you see that right across the board. So maybe we have the US dollar calm down here a bit. Bond markets, long bonds are still contained within that huge doji bars range. And my hunch is they probably will be. It's interesting how the 10-year did go out and clean out those lows. And I had said that that would be like a bearish signal. You're actually almost getting like an empire forming here now. We got, what, about 10 minutes until Mr. Powell starts speaking. So now you can kind of see we had the knee-jerk reaction, and now you can see anybody who took trades just like buy on stop, sell on stop, like that US dollar index trade I just mentioned. You're probably now going to have sort of position squaring. All right, now, had you taken those knee-jerk trades, great, you made some bucks. Let's now sort of square up, and now let's listen to what the hell he has to say. And you might find, everybody, that the whole damn market reverses right back up. You find that Bitcoin's at new highs. I doubt it. It's interesting, actually, Bitcoin on 3-minute chart left a gap here. So that right there, I think, is a tell that we're probably going to have to go back up and trade up there while Powell is speaking. Interesting, you can see a nice little double bottom forming there on Ethereum. And if we change that to a line chart, you probably see it a little bit better. Yeah. So you want to buy on a stop and just risk against that W? Keep in mind, these are very, very low time frame charts. That's basically what this trade in the US dollar was, and you see what happened, eh? So could you see these things all go apeshit just like the US dollar index did there right out of the gate? Could be. Should we why don't we keep an eye on this and let's see how Ethereum treats us, because it looks like it's coming in there, right? That IR is 1317.50, 1318, so it already fired. So let's see what happens. We're gonna buy the double bottom and 2 to 1s. We'll let half of it go, stop to scratch on remaining. Let's see what happens. I see a lot of inverted empires here. Lots and lots of inverted empires. Interesting how the euro dollars, that was the one market we said you wanted to keep an eye on. Now the euro dollar market is over 5%. So that's kind of interesting, eh? Over 5%. All right, Fed funds is only at 4.5. All right, we got 11 minutes to chip out. Speaking, oh, look at the Canadian dollar. It's already starting to come back here. Looks like the Canadian dollar has an inverted head and shoulders working. So any of you guys that are in love with substitute drama teachers, you better get out your spank rag. That's pretty rude. And interesting to see the Aussie dollar doing the same thing. Get a sock. So your spank rag. I remember we said that some of these charts said, oh, look at that, the spanks, look at that. So substitute drama teachers are already kicking in. There you go, substitute drama teachers for the win, baby. Look at all these inverted head and shoulders all coming in. Look at that empire there on the 10-year bond fire. That's surprising considering we took out that low. Stocks are kind of waffling though, eh? Because we took out those lows. If anything, is an inverted head and shoulders, but it's cockeyed. Got a very steep neckline there. And of course, crypto fans, you probably want to see the NASDAQ outperform here. But again, you can see all these inverted head and shoulders all over the place, and the Canadian dollar actually was the leader here. That's fascinating. So we're probably going to see the US dollar come back here a bit. I guess the question is, would you have taken all of the money off the table on that huge rally? I mean, maybe what you want to do at this point is you're long from that double bottom. Beautiful. Gee whiz. I mean, God, you could teach a bloody course on this stuff. I mean, I hope you guys can see this. Take a screenshot of this if you're like, I want to be a trader, man. I mean, this right here, that was the tell. This the market opened up outside of the range here, turned around and closed up well above. So basically, it's a buy on stop right above that level. Now, for the purposes of this, I just said it was a buy on stop above that breakout level there for the big double bottom. But you could argue that's an engulfing bar too. Two engulfing bars right back to back. And you don't get much more of a signal than that. So, I mean, if you seriously want to be a trader and you want to learn this stuff, that right there, you could teach a whole damn course just off of what just happened there. This is like a 3-minute chart. So I wouldn't be surprised. I suppose I would make the argument that no sense in being greedy. If we break down through this low here, that'll be almost a 4-to-1 risk reward on the remaining part of the trade. Remember we said when we put it on, we were going to let half of it go and move your stop to scratch on the remaining. I think you probably move your stop now just below that low there. And if it breaks through that low, then probably the trade's done. Interesting to see euro-dollar market trying to firm up here a little bit. All right, what do we got here? Euro kid joined substitute drama teachers. No breakout there.
Hey,
Japanese
Brian,
yen. Yep.
you do have an interesting question over there on YouTube. Josh just pointed out. So,
What's that?
George Burlaku has a funny question.
Rocco says, explain to me like I was Biden. What is FMOC? It's FOMC, by the way. Now, why is affecting BTC market? All right, so FOMC stands for Federal Open Market Committee. It is the decision-making body for the Federal Reserve Board setting short-term interest rate policy in the United States. So I hope that's the simplest answer. What is FOMC? In 1913, of course, Woodrow Wilson signed away all of our lives by basically bringing the Federal Reserve Board into existence. So the U.S. Fed. So, here is the U.S. Fed. And the irony of it all is that this building, the U.S. Federal Reserve Board, its headquarters, you know what's across the street? Across the street from this is the Lincoln Memorial, which is so tragically ironic because it was the banksters. The banksters tried to break the United States of America because in 1825, there was a U.S. president that kicked the banksters out of power in the U.S. And they were very angry for a very long period of time and very bitter. So how ironic. They went and built their headquarters right across the street from the Lincoln Memorial. Kind of like a big fuck you to him. Thank you, Cotter. It was Andrew Jackson. Old Hickory. And it's interesting how through the latter part of the 20th century and the beginning part of the 21st century, the banksters have done everything in their power to make Old Hickory, Andrew Jackson, look like the biggest villain in U.S. history. And all this sort of, falling in love with the indigenous population and what an evil person this Andrew Jackson was, and these same guys, they funded like Broadway plays about how wonderful the Federalists were. I mean, it's shocking. I mean, who on earth would go to Broadway to watch a Broadway play and spend money to watch a play on banking? I mean, who the fuck watches it? Who's going to want to watch a Broadway musical on banking? I mean, give me a break. What a waste of money. But the banksters funded it, and it turns out that it was a runaway Broadway hit. And everybody's fallen in love with the Federal Reserve System. It's remarkable how the public is so played by these banksters. Anyway, so that's who the FOMC is, right? And of course, TBG Crypto mentions, if you don't know, it's really good history lesson. The Wizard of Oz, that story is all about the U.S. banking system. You wouldn't think it, but it is. And the way that the U.S. banksters literally bankrupted the U.S. Midwest. And sadly, there was one politician that sort of had the balls to stand up to the banksters. And unfortunately, he became like total like pussy. And he is the cowardly lion in that play. Or in that, is it a musical? I think it was a musical. Anyway, so the point of the matter here is that the FOMC is nothing more than the public face of the banking cartel. That's literally what it is. They've so entrenched themselves in the United States government that, to all intents and purposes, it is a U.S. government body. But make no mistake about it, it is a cartel. It is a private organization, which is ironic. It has nothing to do with public entity whatsoever. But they basically act like they're the government. All right, substitute drama teachers, inverted head and shoulders, still working. So it looks like substitute drama teachers are kicking ass. How much? 2 minutes until he starts speaking. Can you kind of see how all the markets are trying to put in bottoms here? Now, why is it relevant to Bitcoin? That was the second part of your question. And I might make the argument that the FOMC is really the body that sets the cost of money to our whole society. And the way that they've set the system up now is really the FOMC and this Fed, sadly, is actually run by international people, the Rothschilds. So it's not even really technically an American. You can't really get angry at it's the goddamn Americans. Well, ironically enough, actually, the FOMC and all these Fed cartels and the whole damn thing, huge portion of it is run by and it's so ironic because it's basically been the story of our human existence for the past like 500 years, is run by just a very select few players, right? The Rothschilds, you've heard of them. And literally they've gone and like substitute drama teachers, he is completely owned by the Rothschilds. I mean, it's almost funny. You saw what happened in England when this latest prime minister, the head of lettuce lady, when she tried to say, you know what, I'm going to make policy here, and she just got absolutely bitch slapped. So that goes to show how powerful the banksters were. Banksters did not want to do what she had in mind, and goodbye. It's often nice knowing you, head of lettuce. See you later. So that's how powerful the banksters are. They can topple these Western governments just like that. If they wanted to, see you later. And this is the irony of a guy like Trump, because Trump's about one of the few people in the world that could actually stand up to the banksters and try, at least stand up. I mean, he may not get them to do anything, but at least stand up to them. And yeah, I mean, you might make the argument that Mr. Biden is completely a bankster puppet. And God, it's terrible, all the policies. He's completely blown up any sort of semblance of value when it comes to the value of currency. It's just thrown right out the window. But keep in mind, that's exactly what the banksters want. Go watch the Money Masters videos. Go watch the Wizard of Oz videos. That's exactly what they want, because that just continues their business model. So they're perfectly happy with the US dollar becoming worthless. And all of our fiat currencies, basically, they're not even worth the paper that they're printed on. And the worst part about it for a lot of these, no, he hasn't started speaking yet. He should start speaking any moment, but my page here is showing I'm still waiting. Do you guys show him actually speaking?
Yep, he's actually speaking now.
Okay, so maybe this is wrong. I wonder what's going on.
Maybe hit the play button.
Oh, well, that's always a good idea. Okay, so, all right, enough of Brian.
Price stability is the responsibility of the Federal Reserve and serves as bedrock of every economy.
I'm going to listen to this, so I'm going to put myself on mute so you don't hear it a couple times.
In particular,
Hit the like button and subscribe, please. I'd rather let him talk.
The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions.
Substitute drama teachers doing well.
Significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
Stocks don't look very happy here, though.
Summary of economic projections.
And Bitcoin doesn't look happy.
Real GDP growth stands at just 0.5% this year and next, well below the median estimate of a longer run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low. Job vacancy still very high.
Well, stocks are breaking.
Job gains.
Looks like the bottom that we were thinking about on the ETH has failed here.
Over the last 3 months.
Whoa, now we're getting, these are bearish bot setups coming in here now.
The pace of job gains has slowed from earlier in the year. The labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
Uh-oh, doesn't like to hear that.
The labor force participation rate has little changed since the beginning of the year.
Oh boy.
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time,
Uh-oh.
easing upward pressures on wages and prices. The median projection in the S&P for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our.
Whoa, look at the stocks getting smoked.
Over the 12 months ending in October.
Foggy boggy levels are kicking in now.
6%.
Those bear ABCD levels. Whoa, look at the risk asset. Oh, substitute drama teacher. Punch in the face. Told you, don't trust anything you see for the first hour here, right?
Show a welcome reduction in the monthly pace of price increases.
2%? What's that? I don't know what that's about.
Substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the S&P for total PCE inflation is 5.6% this year.
Wow.
Almost 3.1% next year. 2.5% in 2024.
Notice no negatives there, eh?
In 2020.
They still expect 2%.
Continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households.
All right, here comes substitute drama teachers.
As well as measured from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched.
That's yeah, that was last year.
Policy actions are guided by.
Look at that, nobody's wearing any masks. Do you see that? Not a single fucking mask.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Oh, there's one.
The committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet,
Well,
today's action, we have raised interest rates by 4.25%.
you know what chart we need to see on here?
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect
They reflect.
the policy
Line, please.
putting in place to return inflation to 2%. We're seeing the effects on demand in the most interest-sensitive sectors.
Okay, so this is all the bullshit that he's talking about right now, is this image.
Full effects of monetary restraint to be real, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year.
At the end of next year.
Projected in September. The median projection is 4.1% at the end of 2020.
They're going to try and keep it there at 4.5% for most of
Still above
the beginning of the year.
Its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes in alignment with supply. Our overarching focus is
US dollar is coming off a bit.
Back down to a 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Whatever that
To
means.
conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can.
Don't fire me.
to
I think he's tenured now. You couldn't get rid of him even if you wanted to. This guy always has good questions.
Market conditions reflecting the policy that's been in place. Since the November meeting, 10-year has declined by 60 basis points. Mortgage rates have come down. High yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort that it's fighting against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
Ooh, good question.
As I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think the financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make.
Look at substitute drama teachers.
And react to our actions. I would add that our focus is not on short-term moves, but on persistent moves.
Ooh, bonds are rallying.
Many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our.
I don't think we ever got a breakout here, did we?
Peak level would be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 were down a peak rate of 5% or more in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that were published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up. If it could move down if inflation data are softer.
Gina, Chair Powell?
James Mayo, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed.
Ooh, look at that. Everybody likes her question.
I wonder what you're looking
Woo, look at the rally.
when to stop.
Holy, that is total program trade. Look at everything's lifting here.
So,
Son of a bitch. That was a program trade right there.
As we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw the
Look at the bonds just taking off here.
It was very important to move quickly. The speed,
Wow.
which we're moving was the most important thing. I think now that we're to the end of this year, and we're in 425 basis points.
Looks like gold's a buy.
And we're in restricted territory. It's now not so important how fast we go.
Come on, Bitcoin.
To think, what is the ultimate level? And then at a certain point.
Wow, look at substitute drama teachers go. Look at that. It's almost recaptured the whole range now.
So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision, but ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at what financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not.
Well, that's a bit dangerous, Joe. Yeah.
And we laid out our individual assessments of what we would need to do to get there. At a certain point, though,
Fucking substitute drama teachers. Buy signals in the bond market.
I knew that would get you, Brian.
You crazy Southern gentleman.
You can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half.
Holy volatility, Batman.
Conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit, and maybe goes back to services a little bit, and we start to see goods inflation come down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up actually as rents expire and have to be renewed. They can be renewed into a market where rates are higher than they were when the original lease was.
Whoa, people aren't gonna like that.
The rate for new leases is coming down. So once we work our way through that backlog,
Pretty much.
next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market. One where we haven't seen much.
It's been in a bottom.
Very high, wages are very high. Vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The other, the goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it. So we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
It's interesting how the U.S. dollar is still so strong here, eh? That would have been just a killer trade.
Because GDP growth in the sense as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening. But it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the S&P are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off. Other than the tech companies.
All right, another double bottom trying to come in on risk assets here.
Because it's been very, very hard.
Quite a doji there on ETH, and not so much doji, but
that doesn't sound like a labor market where a lot of people will need to be put out of work. So that
this one never did come in.
The labor market can come back into balance with relatively modest increases on.
Let's see if this one comes in.
That's guaranteed, but that is what they're forecasting.
So just buy on a stop, one tick above that high. That high is
Thanks, Nick Timorous of the Wall Street Journal. Chair Powell, I want to follow up on.
Chair Powell! Well, everybody drink.
Down the pace of rates.
13.60.
Appears to have been socialized at your last meeting, largely.
13.60, right?
This year. You just want to talk about making decisions meeting by meeting.
Yeah.
Being mindful of the.
There we go. Let's keep an eye on ET. Oh, look at Bitcoin! Bitcoin!
You feel more comfortable probing where the terminal rate is.
Somebody's getting probed? What?
Basis point increments, including beginning at your next meeting.
All right, here we go again.
What size?
Gonna buy on a stop above 13.60, risking to a break of the lows. 2 to 1. It's basically gonna test the top end of the range.
And that will allow us to feel our way and and get to that.
Look at Bitcoin. I think Bitcoin actually looks better.
So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come.
Bitcoin level is 17,891. We have to go on $5, so 17,895. Stop at new lows. 2 to 1 is filling in the gap. Remember we talked earlier about this gap should be filled in.
Just a matter
There you
of
go.
the
Stage has been set.
Any data that comes out during the meeting, and participants know that they have the database that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
All right, lines in the sand have been drawn. Let's see what happens.
From Washington. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as you think it is now?
Well, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we continually expected to make faster progress on inflation than we have. ultimately. And that's why
Bitcoin, please go to the moon.
Between this meeting and
Only they say we go down to 1K.
that's why that goes up.
Mr. Novogratze,
Policy.
we have
And so
bought
in the meeting,
and
but that's
had
slower progress on inflation.
out,
tighter-
bottom it out. Now Brian's singing. Oh boy, cats and dogs are living together. Remember when he said inflation was transitory? No, I'm not drinking. I'm drunk on PMA. That's what's going on. Bottom it out.
Than what you see written down there. But why do we think?
Ooh, look at Eurodollar. Eurodollar contract has turned back up. That's interesting.
That vacancies can come down there.
US dollar's still hanging in here.
They don't want to let people.
Substitute drama teachers, bottom's still hanging in. Did the substitute drama teacher get stopped out?
Structural labor shortage out there where they're.
Oh, he did.
Who were in the workforce available to work. and
Painful.
demand for work. So the fact that there's a strong labor market.
Actually, both of these, both the Aussie and the Canadian dollar broke to new lows.
That it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonable.
Whoa, there goes the US dollar. Bush! Down she goes. Oh, that trade's done.
We'll see.
I mean, substitute drama teacher should do well here.
Thank you, Colby Smith with the Financial Times.
Colby. Hi,
Can you
Colby.
interpret the higher core inflation forecast for 2023 in the SEP? Does
Colby.
suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Catch all those numbers?
Was that core came in stronger this year? Yeah, what you see is our best estimate as of today, really, as of today, for how high we need to.
There goes the euro. There goes substitute drama teachers.
Restrictive policy to.
I think this was all predicated on this euro dollar market bottoming here.
Inflation down through those channels. That's all you.
Wow, look at this US dollar all over the map now here.
And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing. We're going to publish it.
Hi, Victoria. Yeah, this Florida. I wanted to make sure I
Victoria.
understand specifically what's going on.
No, none of the ladies are saying Chair Powell. What the hell, man?
But you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth? That you expect wage growth to be sort of a headwind?
Well, we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So, we're moving down still by a very large. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balance.
That's this talk, Joe.
Market, so that you have, it's not
Inflation is falling.
strongly. We just
Sort of.
That's consistent with 2% inflation right now.
I mean, the funny thing is all of this talk is all bullshit. The long and short of it here is if they're decreasing the money supply in the system, then that should bring inflation down. Question is, how much can they actually do here before the whole fucking thing starts falling apart?
The futures markets have priced in some easing in the back half of next year.
I mean, it's almost laughable how he talks about all this double talk when really all of this comes down to the simple money supply issues. And that's, you know, we made reference earlier to the Wizard of the Oz, the Money Masters, Milton Friedman. That's all about that. Inflation is money supply.
Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
And I think we said everybody should know this is nothing out of the ordinary whatsoever. We don't expect rate cuts or falling interest rates until August through December 2023, beginning of 2024. There's no reason to be thinking about interest rates going down anytime soon.
For commodities prices. And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices.
China.
Ultimately, that could push inflation up in the West. It's very hard to say, you know, how those two will offset each other, and it doesn't seem likely actually that the
Eurodollar's rallying sharply.
But to your point, China faces a very challenging situation in reopening, and we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing.
Are they out now? What does that mean?
For manufacturing and exporting, their supply chain is very important.
Well, I don't know.
Reopening, they've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky.
This is what I'm most worried about right now, folks.
It doesn't seem like it's likely to have material overall effects on us.
Remember, everybody was poo-pooing in January 2020.
My question, I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this.
Don't look good for the cryptos here.
What we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation.
Geez, gold looks strong.
We've been expecting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting
pretty clear line in the sand being drawn in the bond market now.
That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year. So that should help. And the big piece again is core services ex housing, which is very important. And we have a ways to go there. We do see some beginning signs there, but ultimately that's more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market. And
ETH is slipping. Slippy.
With the last payroll.
Slippy. Her name was Slippy.
Much progress in terms of our average hourly earnings coming coming down. Now there may be composition effects and other effects in that, so we don't put too much.
Interesting how crypto looks so weak here.
These things can be volatile, but we've been looking for wages moving, down to more normal levels where workers are doing well, and ultimately their gains are not being eaten up by inflation.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made.
Notice these two guys side by side.
And I'm wondering,
These guys are like the old timers in the whole media.
markets have loosened financial conditions, or if you feel the Fed maybe a little bit behind on inflation.
Uh-oh.
Whether in
He didn't say the Fed's behind not doing a good job, did he?
And how this affects the
Ooh, look at stocks.
soft landing if you're projecting just 0.5% growth for this year.
Oh, stocks are bottoming.
So if I think I got your question. So, one thing is to say is I think our policies getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive.
Wow, substitute drama teachers are happy.
To get there. It boils down to how long do we think this process is going to take?
Whoa, here comes the cryptos. Come on, you cryptos. Are these trades going to fire? It looks like they are. Here comes Bitcoin. Here comes Bitcoin. Oh, it almost broke out. Not quite.
Housing services, but
Oh, come on, Bitcoin.
we're really
Come on, Bitcoin.
progress there, and that's going to take some time. I think my view.
Let's go, Bitcoin.
Is that this will take some time. We'll have to hold policy at a restricted level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome. We need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see.
It sure looks like crypto wants to rally. Come on, crypto.
No, I wouldn't say that. No, I don't say that. I mean, I would say this. To the extent we need to keep rates higher and keep them there for longer, inflation moves up higher and higher. I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible.
Wow, look at Bitcoin go.
Whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not, it's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain, how you describe that to Americans if the projections on unemployment find themselves. That would be 1.6 billion Americans out of blocks.
Crypto couldn't break out.
The largest amount of pain, the worst pain would come from a failure to raise rates high enough and from us allowing
Does the
inflation to
entire printed money supply over the last 2 years
the ultimate cost
to be removed from the system in order for the inflation to get to 2%?
in
No,
terms
no.
of employment.
no, I don't think you're ever going to see that money disappear.
Thing that had to happen when inflation really got out of control, and if that didn't respond
Go to,
in the prior episode.
what they really want
So that's
is
really
they,
the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people, and so people are paying higher.
I don't know how to
rates
make this
and that
full
kind of
screen.
thing. There will be some.
This is the problem. They got to get rid of this,
This would be painless way
and they got to get back to this.
to restore price stability.
So you can see for year-over-year comparison, that's 2.5%.
We can do.
It's still increasing, but this is unsustainable. So they have to get back to this world. And, here's the money supply. It's not really, I mean, is this money supply ever going down? Not really. But what they want to do is they got to stop this. Fucking money printers just going crazy. And they got to get back to this. So that means they really should contract the money supply to here. Right? And then that would bring the inflation back to there. But don't expect this to go down anytime soon. What will probably happen is we go like this to work our way back to that trend line. Then they start back on that trend line.
Not considering that, we're not going to consider that under any circumstances.
I hope that helps answer that question.
Inflation target at 2%.
You can see they're trying to bring the inflation rate back in line. This is just completely unsustainable, this shit here.
Thank you, Chairman Powell. Nicole Vickers here in business.
Chapa!
As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential?
Come on, Bitcoin.
Inequality in
Come on, Bitcoin.
calculations, especially given the K-shaped recovery of 2020?
K-shaped recovery, you hear that?
I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. And the gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we can get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for.
All he's telling you is we're going to do what we did in the 1940s and 50s. It's the same bullshit, just recycled. There's Bitcoin. Looks like Bitcoin's going to break out here. Oh, what a tease. Does that Bitcoin break out? Just one? Who won?
So when it gets lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
Oh, I thought Bitcoin was going to break out there.
We do, yes, we absolutely do. We look at it's a regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on it.
Are you racial profiling? Oh, no. We don't do that. No, we don't do that.
It's Marshall Genser with Marketplace. What would you do if the economy's
Grandma's woo, nice glasses. Her or the other one?
Signs that inflation is slowing. In other words, stagflation.
Stagflation. Ooh, I don't want to hear that word.
Too many hypotheticals, but
don't talk that way. Shut the fuck up. Get the hell out of the room. Your press pass has been revoked.
Let me just say.
Come on, baby. Here comes Bitcoin. All right, looks like the trade's coming in. There it is. It just fired. Yeah, we should rally up and fill in this gap now. If we get any kind of market structure below this trend line, though, we're toast.
So the limit is very, very strong. Where we're missing.
There you go. Looks like Bitcoin's off to the races.
So that means we need to really focus on getting.
There's the entire printed money supply of that now. Okay, so Miss Sec, hopefully I answered that question for you. Hey, there goes ETH. So don't leave me behind. What the hell, man? Gotta get inflation down. Let's go, cocksuckers.
From Market Watch. You spoke a little bit ago. You said that the U.S. looks like we have a structural labor shortage in the economy. Can expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration?
Boggies.
Thank you.
So what
Chaos theory can come in here now.
Labor shortage is, if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus.
And interesting how ETH just won't break out here. Stocks should be happier.
And you're more.
Yeah, look at that. Stocks are rocking it. Oh, by the way, all you YouTubers, Google wants me to insert an ad here now. Jerks.
The upshot of all that is the labor market is actually, it's.
Hey, there goes ETH. ETH broke out. Woohoo!
Based on pre-pandemic.
Here comes ETH now.
And reasonable population. Our labor force should be 3.5 million more than it is, and that it can either there are lots of easy ways to get to bigger numbers than that. If you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost.
Nice. Look at the rally.
Who would have been more close to half.
Rally. Picture's named Sally.
And part of it is that migration has been lower.
2.618.
You know, it's not our job to prescribe things.
There we go.
I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So
need more people.
Identify that in mind.
I gotta get more coffee. Need more coffee. So we're long Bitcoins and we're long ETH. Woohoo!
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. What we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And
whoa, everybody's like, hey, wait a minute, you can't go get coffee. We're gonna stop you out.
We don't, of course, we don't.
Oh, France scored. French lady should be happy.
We make those forecasts. The staff runs, and you will see this if you look at the old teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things, but that's just upside and downside scenarios. Of course, that's responsible practice that we carried on for many decades.
Jeez, look at all these W's. W's everywhere. This is scary though, because where are we? We're about 45 minutes into the press conference, eh?
I wanted to ask you about the SEP again. If you're reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know we'd see. But as I mentioned, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are.
Yeah, this gets scary now because this bond market's moved up quite a bit now. We lose that level, you're probably going to see the bonds come back to this trend line.
Inflation's coming down. Thank you very much.
Oh, is that it? Wow, that was an unceremonious end. And we're out of here. All right, well, there you go, folks.
Looks like we are out of here then.
All right, well, that is now that. So.